there's a deep bench at Berkshire. From that deep bench, Warren eventually tapped Greg, and so promoted him to vice chairman. And at this most recent annual meeting indicated that he has been gradually delegating more and more of his role to Greg. So when managers of the businesses have a question or need some advice or need an introduction to somebody, they tend not to call Warren anymore. They tend to call Greg.
On Wealth Track, Berkshire Beyond Buffett author Lawrence Cunningham on the outlook for one of the most valuable and storied companies in America.
Funding provided by ClearBridge Investments, the Fairholme Foundation, First Eagle Investments, Royce Investment Partners, Baird, Bill Miller, Research Affiliates, Strategas Asset Management, Women Investing in Security and Education, and Matthews Asia.
Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. No matter how you look at it, Berkshire Hathaway is a big deal. It is ranked number 5 in revenues in the Fortune 500. Its $364 billion in sales places it behind Walmart, Amazon, Apple, and United Healthcare, but ahead of CVS Health, ExxonMobil, and Google. And it is the 8th most valuable company in market cap with a stock market value of nearly $900 billion as of mid-2024. A constant concern surrounding Berkshire is what the company will look like when Warren Buffett is no longer around to guide it. A current question is how will the death of Charlie Munger, Buffett's longtime business partner and counselor, affect Buffett and the company? We are going to put those questions to Berkshire expert Lawrence Cunningham this week in part 2 of our interview with him. In part 1, which you can see on wealthtrack.com, we discuss Cunningham's best-selling book, The Essays of Warren Buffett. Now in its 8th edition, the book is a collaboration with Buffett summarizing and organizing his 4 decades of annual shareholder letters. Cunningham, a corporate governance expert, founder of the Quality Shareholders Group consultancy, public company director, and prolific author, also wrote Berkshire Beyond Buffett, The Enduring Value of Values several years ago. He recently led a panel on Munger's influence on Berkshire for the Museum of American Finance, the only private museum in the U.S. devoted to a history of U.S. finance. And we will provide a link to it on our website, wealthtrack.com. The panel topic is the starting point for our conversation. How important was Munger to Berkshire's success?
It was essential, and Warren even tried to measure it at some point, tens and tens of billions of dollars. And, Warren put his whole ego into Berkshire, and so, it's his baby. But Charlie coached and advised and was along, and not just along for the ride, but really leaned in and helped Warren evolve and grow. So I think, Buffett would have been a phenomenal success anyway, but I think the Berkshire that you see is surely partly due to Charlie.
Warren calls Charlie Berkshire's architect. Well, I just was amazed in his tributes to Charlie, how he just said that they never badmouthed each other to anyone else, and they never really had a hostile argument. They just got along and they listened to each other and respected each other. And I'm sure they had disagreements, but they just had an extraordinary relationship.
Yeah, they were very good-natured about their disagreements, and they just sort of made jokes about it. And the disagreements were typically, it was mostly about substantive decisions Berkshire had to make, and so there were just business different points of view. And in their company, what they're mostly doing is trying to evaluate the prospects of a business. So it's easy to disagree because no one has the crystal ball. So that's when they disagreed, and it would be about what level of information, what level of comfort do you need in order to commit this capital. And Warren, I think, was occasionally more willing than Charlie to do that.
So what Warren called Charlie was the abominable no man.
Yeah, there was a movie, Abominable Snowman, I think, when he minted it, because Warren would have some wonderful opportunity, some great idea has come his way, and he's thought hard about it and analyzed it and thinks this would be an attractive investment for Berkshire. He didn't always call Charlie, but when it was a substantial investment or a difficult decision, he would. And Charlie would listen carefully and then either say sure or no, I don't think so. And that might be the end of it. And Warren would sometimes proceed with an acquisition despite Charlie saying no, and admitted on a couple occasions to having made a dumb decision and regretting it. The way I read it is one of the reasons Berkshire was so successful, Warren was so successful, is Charlie's willingness to veto improvident acquisitions. So he contributed a lot of value by avoiding mistakes rather than sort of seizing particular opportunities. So it's a little harder to measure, but Warren would know what those decisions not to invest in something were.
So most of us don't know how it worked because Charlie Munger had a law practice, right? So describe, I mean, how the relationship worked, how active it was. Was Warren consulting him every day? Was it just on big decisions? Just trying to get a sense of what the input was, and again, why it had such import.
Charlie founded that law firm, Munger, Tolles & Olson, but then pretty soon retired from the practice of law. He liked being a lawyer, but he said, I'd rather be a client. So he still went into that office, and his name is on the door, and he influenced people there, but he didn't really practice. And then he created an investment firm also called Wheeler Munger. They had about a 12-year run with spectacular returns. And through those activities, he and Warren met through joint ownership of a company called Blue Chip Stamps. And so they started working together, and they went through a lot of interesting transactions through Blue Chip Stamps back in the 70s. And they just got along. They liked each other. They saw the world similar ways. They had great integrity and great intuition and appreciated the value of relationships. They finally made a decision together to merge Blue Chip into Berkshire. And so they're each now very big shareholders in Berkshire, Warren a lot more than Charlie. And Warren's going to be the chairman and CEO, and Charlie's going to be the vice chairman. Charlie's living out in LA, and Warren's in Omaha. But by virtue of that partnership, and that's how they felt about each other, they stayed, they were in touch all the time, just regularly, not necessarily always on business. I mean, they went on trips and, played golf and went on vacations together and all that, deep, close friendship. So they talked, I think, all the time. And then, on big decisions, I mean, yes, if they're looking at an opportunity and Warren has any doubt or just believes it's so significant, he just talked to Charlie in the ordinary course about that. And of course, Charlie was also on the board of Berkshire, which meets a few times a year. And so they were very, very close.
You wrote a book called Berkshire Beyond Buffett. So what does Berkshire Beyond Munger look like?
Yeah, that's a really overlooked topic because I think as we've been discussing, I think one of the most important things a leader needs to do is pick a number two. Pick a person she or he can trust on any topic and be willing to trust them so much that to listen to them when they say no. And so having that number two has been critical for Warren, and Charlie's absence will affect Warren.
And also, I might say that number two usually infers that you're above, that you are the superior at a number two. In this case, they were equals.
Yeah, that's a great point. And that sort of model is unusual in business. There are some other examples where it's sort of a true partnership.
True co-CEO or two.
Co-CEO.
Right.
And in Warren's case, yes. So I think without Charlie, I mean, I've been seeing Warren over these 6 or 7 months. He's a stalwart, focused person. I mean, in his tribute to Charlie, he said, "Look, I'm going to give a very warm, encomium here at the beginning, and then I'm going to get down to business because that's what Charlie would want us to do." And so that he's down to business. At the same time, he has for many years been trying to delegate more and more responsibility to his senior leadership, his colleagues, especially Greg Abel,
right.
the vice
So let's
chairman.
talk about that. So this is the Berkshire Beyond Buffett as well. Explain to us who are not as familiar with Berkshire what kind of management structure he has set up. And I think you told me in a conversation earlier that Warren has already stepped back somewhat.
Yeah, the Berkshire model was to buy parts of companies or all of companies that are well run and managed by effective and trustworthy managers, and let those managers have nearly total leeway on operations, products, branding, customers, employees, acquisitions. And so the whole model of Berkshire Hathaway is a very highly decentralized model that gives those managers vast autonomy. And in order for that to work, it has to be a place that believes in trust, that runs on trust and accountability, so that there aren't a lot of internal controls and reporting and cross-checking and supervision and meetings and all that stuff, but there's trust so that every manager is expected to deliver performance, report performance, own up to mistakes promptly, deliver bad news even faster. And so that's been the model, and beginning in the 70s with their early acquisitions and then compounding that over 80 acquisitions over these 50 years. And so the structure of Berkshire Hathaway is very highly decentralized. They have just a small headquarters staff in Omaha, most not operational people, mostly accounting and internal audit, making sure that the accounting all rolls up. Buffett jokes that I do have an auditing staff. There's no sense of being a fool about it, but those managers do have questions. They will sometimes need some guidance from headquarters, and a person like Warren where Charlie was wonderful to provide it, because they had very good insight, judgment, and also they knew other people around the company. If a product problem had appeared at this company, well, he'd be able to suggest another CEO at the company to turn to. So his role was very much the sort of central figure in this firm, and it's a very important role. So Greg has been increasingly taking over.
Greg Abel. Mm-hmm.
Greg Abel, yeah, Greg Abel.
Vice chair on non-insurance operations and energy.
Yeah, he joined Berkshire in about mid to late 90s through an acquisition when Berkshire bought an energy company called Mid-American Energy. That's a very big part of Berkshire Hathaway. It's one of its largest businesses. It is an acquisitive company. It's made numerous investments in many different public utilities, wind, solar, pipelines. So it's a very large player in that field, and Greg has led it with great skill and deployed the capital very effectively, and he's become well known to the other CEOs of Berkshire's other companies and gained their respect. About 10 years ago, as I was writing this book, people began to wonder, okay, well, what's going to happen to Berkshire Hathaway after Warren leaves the scene? And there's a deep bench at Berkshire. From that deep bench, Warren eventually tapped Greg, and so promoted him to vice chairman, and at this most recent annual meeting indicated that he has been gradually delegating more and more of his role to Greg. So when managers of the businesses have a question or need some advice or need an introduction to somebody, they tend not to call Warren anymore. They tend to call Greg. And Greg loves it. And I think there's an interesting advantage, I guess, a plus for Berkshire, because Warren, never really ran a business. He never was an operational manager. He was an investor, and he bought all these companies and would certainly have some leadership skills and some sense of organizational design. But he wasn't an operations person, in terms of customers or products or branding or marketing, managing for change and leadership. Greg has done all that. So when the managers have a problem in the old days, they'd call Warren. He'd probably give them some terrific, wonderful advice, guidance, and then introduce them to somebody. With Greg, I think they're probably getting immediate operational insight on their problems. So I think look, Warren's irreplaceable, and he's got galactic skills no one will be able to fill in. But Greg has some strengths that Warren might not have had. The way I think about it, there's no better pick for a successor to Warren than Greg.
And then I know there's Ajit Jain, who's another vice chair, who heads the insurance operations. I mean, then there's the investment portfolio as well. And so how's that all going to shake out?
Yeah, Ajit Jain, we started this conversation asking about what contributions Charlie Munger made to Berkshire Hathaway, and we said that was considerable. Warren would tell you that Ajit made even more valuable contributions than either Charlie or Warren did. He used to have a joke that said, if the three of us are at sea in a sinking ship and only one of us can be saved, save Ajit. Ajit came to Berkshire in 1984 from McKinsey. He had been a consultant and he wasn't satisfied in that job, and he was very attracted to the insurance business at Berkshire Hathaway because he has a very analytical mind, can calculate risks and probabilities, and so it was a really neat match for him. Warren hired him, and he went to work executing, figuring out how to price complicated risks and business policies and catastrophes and stuff like that. And so he really led the insurance businesses at Berkshire to be some of the most formidable in the business. And so when they elevated Greg to vice chair 8 or 6 years ago, of the non-insurance businesses, they appointed Ajit vice chairman of all the insurance business. And so he has broad oversight into 6 or 7 different large insurance companies. We were talking also about how Warren benefited from having Charlie as a sort of co-equal number 2. I think there's a way that Greg Abel has Ajit Jain as a sort of co-equal number 2. If he's having a problem,
sure,
Ajit's the perfect person. Also, I think that that partnership between Greg and Ajit also adds a lot of value. On the investment portfolio side, we've been talking about what Greg and Ajit are overseeing are these wholly owned businesses, but Berkshire also owns minority stakes in common stocks, and Warren has been helped in managing that portfolio by 2 outstanding investors for now going on 20 years, Todd Coombs and Ted Weschler. And with them, it is really interesting because about 5 years ago, the CEO of one of their very important insurance subsidiaries, Geico, that's the famous car insurance company with that gecko creature.
Oh, sure. Mm-hmm.
Well, the longtime CEO of that business, Tony Nicely, was retiring, and so they needed to find a successor, and Todd expressed interest in it. And so Warren asked Todd Coombs to become CEO of Geico. So I think he still plays a little bit of a role in the investment. After all, Geico is one of the companies that has capital that needs to be invested, but he's really now kind of leaning into that operation. And the other notable thing at the succession plan that had been announced until just 2 months ago had been that, well, Ted, with Todd's help, would take over managing that portfolio. What Warren announced at this year's annual meeting was that those guys will still be involved in it, but Greg will actually be the responsible person. Mm-hmm. So he's going to have oversight of that too. And now that's, it's obviously an important role, but note that in terms of relative size, the stock portfolio is about 1/10 of the overall Berkshire Hathaway. So 90%, what Greg is overseeing otherwise is really most of the value. And that 10%, it's not as if they're doing lots of trading every day. I mean, they make adjustments and do fine tuning, and it's important. I don't mean to diminish it, but to have it as an addition to Greg's remit is not, it's not going to tax him. It's not going to overwhelm him. He'll be perfectly capable of overseeing that as well, I think.
Larry, right off the bat, I can think of some things that might be brought up if and when Warren decides to leave the company. One of them certainly is a dividend. The company's got a lot of cash. It has not paid a dividend to shareholders. And the second thing where it might come under pressure too, and it might change, is the fact that this concept of permanence, that Warren has been willing to basically go along with companies that they own, even if they're not performing that well, that they're not going to get rid of them. They're willing to stay with them. I want to own a company forever, and so this hands-off. Is it possible that either one of those policies could change, or will there be pressure to change them?
Those are great questions, and there will probably be pressure, and the company has always faced a little bit of pressure, probably from a small number of people, to pay a dividend or to sell off underperforming businesses, and that pressure may well increase post-Warren, and Greg will have to confront it. My prediction, and a well-founded belief, is they won't change the policy, but the result may change or be adjusted. So by that I mean, on the dividend, the policy has always been that we will retain $1 of earnings if, by doing so, we increase the market value of Berkshire stock by that $1. And if we can't do that, we will pay the $1 out. And so for 50 years, and he conducts rolling tests on have we been able to do that. Over that time, they have. And so that's the policy. And so far, Warren's not felt that they failed it or needed to pay.
Got it.
Now, that could change with, especially as you say, you've got $200 billion of cash sitting there and an opportunity set that may be small. You may get to a break point where, no, we cannot do better with that dollar than the investors can, or we can't get a dollar market value for that dollar retained earnings, so we are going to pay a dividend. So that may happen. One factor is that Berkshire shareholders don't typically have an appetite for receiving a dividend. Most of them are taxable shareholders. Most of them have other income, other sources of liquidity, and so receiving a dividend imposes a tax on them whether they like it or not. So Berkshire has in the past tried to use some of that excess cash by buying back stock from people who want to sell. So I think they'll continue to try to do that, to use some of that cash. But so that's a subtle, the policy I think will stay the same, but the calculation might be different. On the permanence, one of the reasons for that commitment to permanence is that it helps to make Berkshire the buyer of choice for certain sellers who are interested in preserving the family's name or having some entrepreneurship and not going through the anxiety of in many markets, businesses are bought and sold, and that can tax a manager. And so that commitment to permanence helps induce sellers to come to Berkshire, and sometimes they even get a discount in the purchase price. In Berkshire Beyond Buffett, I call that the value of values, that by making that commitment to permanence, you might be able to pay less in cash. Disturbing that policy would be risky, dangerous for Greg or Berkshire to do. But I think what might happen, this is where the subtle difference is, historically, Warren has assembled this wonderful collection of businesses and given enormous autonomy to managers. Charlie used to joke that we delegate responsibility almost to the point of abdication. And it's a joke, and it's meant that way, but what it has actually meant is that some managers hide within Berkshire. There's some businesses that are lagging, but not because the economics have deteriorated, because the manager is not leaning in. And I don't think Greg will operate the same way. We were just discussing, he's an operations person. So when he sees this business is not performing at its peer or better, I think he'd be more willing to, within the framework of autonomy, just say, yeah, we need to coach a little bit. How can we solve this so that we continue with the commitment to permanence, even with autonomy, but with I call it intelligent autonomy, and so don't need to sell the laggards because we don't have them.
One last question, and that's one investment for a long-term diversified portfolio.
I'd pick Credit Acceptance Corporation, not a household brand name, but they're in the business of making automobile loans for people without sterling credit ratings. So it's a real helpful business. They're helping ordinary Americans in trouble get cars, which are sometimes critical to go to work or take the kids to school. And so it's a very valuable service. It's a difficult business because sometimes these people cannot pay, and you've got to counsel them and work things out. But the managers of this business have always executed it in the most ethical manner and the most shareholder-focused manner. They're always trying to figure out what's the loan portfolio look like in terms of deploying capital, and are we doing right not just by our customers but by our stockholders.
Larry Cunningham, once again, thank you so much for joining us on Wealth Track and sharing your reflections and analysis of Berkshire Beyond Buffett and Beyond Charlie Munger. Thanks so much.
My pleasure. Thank you, Consuelo.
At the close of every Wealth Track, we try to give you one suggestion to help you build and protect your wealth over the long term. This week's action point is a recommendation from Larry Cunningham. When asked to name a book about Buffett that he couldn't put down, his answer matched my own suggestion. This week's action point is read Buffett, The Making of an American Capitalist by Roger Lowenstein. Published in 1995, it was a bestseller from the start and has become a must-read biography of the Oracle of Omaha. Lowenstein, whom I was fortunate to know as a colleague at the Wall Street Journal many years ago, is a superb journalist. There have been many books written about Buffett since, but Lowenstein captures the essence of the man who was obsessed with making money from a very early age, not for ostentation or power purposes, but for the challenge and fun of it. The story of his fixation and making a buck throughout his life is fascinating and has certainly paid off for him, his family, friends, and legions of loyal Berkshire shareholders. Next week, to launch our 20th season, noted strategist Rich Bernstein explains why deglobalization is bigger than AI for investors. In this week's extra feature, Larry Cunningham reveals how Buffett influenced his interest in corporate governance. Please follow us on Facebook, X, and our YouTube channel. Thank you for watching. Have a happy 4th of July celebration and make the week ahead a healthy, profitable, and productive one.